just by that
statement. Not at all. Remember, Tax Tuesday, we're bringing tax knowledge to the masses. That's our goal here. So we come on here every other Tuesday, and it's questions from you. You submit the questions through our email chat, or excuse me, our email site, taxtuesday@andersonadvisors.com. I run through all the questions, pick out those that we can put onto the program. We have a select few that we can take, and but we do answer all your questions that you submit. Also, during the presentation today, if you have any questions, feel free to put them through the Q&A section, the question and answer section. Please don't put them in the webinar chat. And we have a whole team here in the background, a lot of accountants and attorneys answering your questions, bookkeepers, etc. So they'll handle a lot of those questions. And so we just try to make this fast, fun, and bring a little bit, again, tax knowledge to you all. And so then we will get on to
you say you make taxes fun.
Yeah, we try.
Wow. All right. Start out that way, right? So.
Exactly. It's fun time. So we got about 9 questions today, and we're going to hit right at them.
Great.
So first question, I'm considering a late S election effective January 1st of 24. Okay, so we're going back in time here for an LLC. I understand it's late in the year to get everything in order. I've heard others recommend an option to avoid payroll for 2024 by issuing a 1099 miscellaneous as officer compensation in lieu of a late payroll, then get payroll set for 2025. Would you suggest this 1099 approach, or is there still time to get payroll done for all of 2024? So Clint, what we're looking at here is the requirement on an S Corp to pay a reasonable wage.
Yeah.
We always got to do that. If we take a distribution, we got to pay that reasonable wage. And so what they're asking here is, well, maybe I can't get that payroll done before the end of the year. We're getting towards the end of December. So maybe I can just 1099 it to myself, kind of call it, because that's going to get hit with employment taxes. Government doesn't care, do they? They get it taken out of there. I still get my payroll, and then I'll do it right next year. People do advise doing that. We don't here at Anderson. We want you to roll the proper W-2 payroll. And yes, there's plenty of time. There's payroll companies out there who can do this relatively quickly, but you do want to get on it. And we want to make sure it's paid before December 31st. We do not recommend the 1099 approach, although it does probably, honestly, if you got audited, I don't know that the IRS would say anything, but it's not proper. And you want to do it the right way and make sure you have it all coming on to your 1120S.
I like the way you set that up for me, because you said, hey, we got a blonde attorney here and I got to make it real simple. Elliot, you do a phenomenal job of that, taking complex subject, because you lost me halfway through that and you broke it down now so we can understand that. That was a good answer.
Yeah, well, thank you. I learned from the best.
Yeah. So why do we want to take the compensation here? What is that issue for them? Isn't there other ways they can pull money out? Why do you want to show compensation? Why not try to take it out as a fringe benefit, maybe hire your kids before to the end of the year, pay them? They have their own standard deduction. You could use that again so they don't have to pay taxes on it.
That's exactly right. There's all kinds of strategies we can use to hit that income that you have in your S Corp before we have to consider the reasonable wage. And that's exactly what we try and do through tax planning. If you have questions about that, what kind of strategies or how would they really impact, we're going to talk about that a little bit later, but we do have a program set up for that, Tax Saver Pro. Mm-hmm. We're going to look into that. But Clint's exactly right. Why not hit all these things first before we have to do that payroll? Because if we lower our overall income, then the amount of payroll you have to do is less, and you're going to have less employment taxes on it. That's exactly right. That's an excellent idea. So we will talk about that later on in the program. We'll look at that. However, at some point, we do know you have to do that reasonable wage if you take any distribution. That is to say, if you ever take any of the money out from your S corporation, that's where it kicks in the code and says you got to pay that reasonable wage.
And so what I would also look at too, I'd mentioned, if you want the compensation, then that would imply you want to contribute money to a retirement plan. Right?
Exactly.
Solo 401k, you could set that up before to the end of the year. You don't need to fund it right away. You can still wait until you file your tax return to fund it for the prior year. You just have to get it in place before the year's up. So those are options. Self-directed IRAs, you can make contributions to as well. So yeah, it makes sense to have compensation for those types of opportunities.
Absolutely. And that's the whole carrot and stick that the government approaches us with for those contributions. They have to be earned income. That's the W-2 part where you're going to have employment tax. That's going to gauge what you can contribute to those plans that Clint is talking about.
You just called me Toby?
I did not.
Yeah, you did. Here, if you want me to look like Toby, I can get down here, a little shorter.
So there you have it. I think that's our S election, late election.
All right.
All right.
Let's hit the next one.
Next question. What type of businesses do I need to set up a solo 401k or a Roth IRA? Kind of a little bit of a trick question here. For a solo 401k, any business can be a sponsor. It could be your disregarded entity. It could be your S corporation, like we just talked about. Could be a C corporation. Could be a partnership. Anywhere we have earned income, it can sponsor a plan like a solo 401k. But our Roth IRA is a little bit different. That's for the individual, okay? So now we've got a situation where the individual has already earned some money and will put into a separate plan, the individual retirement account, the Roth, but that's not coming from your business. That's after the individual has already been paid, whereas your solo 401k is being sponsored by a business. So a little bit of a difference there, but you could do both in the same year.
Okay, so to put the legal spin on this, if you want to set up a solo 401k, what's essential here is that you can have only one owner, and you can have, or two if it's your spouse, and you can't have any employees. More importantly, the mistake they see a lot of people make when they want to set up a solo 401k, they have another business, and that business has employees, and they think, I'm going to go do this side hustle over here, this side gig, and that's where I'm going to have my solo 401k. I'm not going to do anything for my employees on the other side. That's a problem. You cannot set up a solo 401k in that situation. So if you already have a company with employees and you want to set up another business, it will not work. If you're looking to set up a business and actually I said spouse, but you can have a business partner and you want to hire people, solo 401k is not going to be an option for you. But if it's just you and your spouse, you and a business partner, that's a great idea. The other thing here that when you brought up Roth IRA, you remember a solo 401k has a Roth component built into it.
Absolutely.
And so if you wanted to contribute to a Roth, I would probably look at the solo 401k and use the Roth component built into the solo 401k versus doing a Roth IRA, because it gives you a little more flexibility in the control of those funds. In fact, there was a question that came up here by an individual about the backdoor Roth strategy. Well, we started talking about this probably about 15 years ago before it really caught on, and we would call it the trapdoor, which means this, that you can actually pull money out, or you take out a salary out of your company. So if you set up a solo 401k and you're paying, I don't know, 50 grand a year in salary to yourself, you can take that salary and you can contribute personally 100% of it to your solo 401k plan as an after-tax employee contribution. So it goes into your 401k plan, and you can immediately roll those funds over into your Roth portion of your 401k. So you can put into your 401k Roth plan, not $7,500 a year, but up to 60, what's the limit now, 60 something?
$69,000.
$69,000 a year. So if you're pulling good money down out of your business, and you want to start developing a retirement plan that is going to be a tax-free retirement future for you, a solo 401k, there's a ton of options there.
Definitely, yeah. That's solo 401k, as Clint just pointed out, gives you that higher contribution amount, whereas your Roth IRA, again, is just for the individual, and it has a much more limited contribution amount. So a really good game plan. Again, you're learning from the best every 2 weeks. Toby and Clint show.
Yeah.
All right, next question. Can you review the contribution rules for a solo 401k and for an IRA in 2024? For instance, when you defer income at year end and make a company match, then also the IRA contribution if possible. Confusing area for many. So again, just building off our previous questions here, pretty much the rule for an individual, and again, you determine how much you're paying yourself, the sponsoring entity's paying you as earned income. You can contribute up to $23,000 as the employee. And then the employer can contribute up to 25% of your earned wages from that business. So in other words, let's say you made $100,000, you could contribute as an employee up to $23,000. The employer can hit up to 25% or $25,000 with an overall limit of the $69,000 that Clint was just talking about.
I agree.
Yeah.
Yeah.
So and now as far as timing, one of the rules that we got to watch out for, we got to have that earned income prior to December 31st of that particular year. In other words, you can't get paid say the first or second week of January next year and have it revert back as the employee. So we got to know, a lot of this is based on how much the employee is making in that earned income we've been talking about. The employer, the business, the S Corp, it has all the way until its extension time for its return way into the next year before it has to put its money in. So it's got plenty of time to pony up and put its 25% in, but we got to have it all based on that earned income, which has to be by December 31st.
And a lot of times when you're looking at putting in that 25% from the company, it's not going to all be deductible because it's based upon your wage. So if my company was going to fund my plan with 30 grand, then in order for that to be deductible, I would need to be earning, I can't do the math, $150,000 in salary, something like that, 25%?
120.
120. So you have to be taking a salary of 120 in order for that contribution to be 100% deductible. And this is a mistake that I catch a lot when I talk to people about this. I go back to that original strategy I just referred to, that trapdoor Roth. Hey, if your business can't deduct it, then why not just take the money yourself and contribute it right into the Roth account? Because if your business makes that contribution, that money goes in, when you pull it back out, it will be taxable to you. So your business didn't get a full deduction for it, and it comes back out to you and it's taxable. So you're better off, in my opinion, taking it out personally and then recontributing the funds.
Excellent game plan. As far as the IRA, excuse me, that does also have a deadline, although we have until April 15th. Because it's individual return, individual due date is April 15th on your 1040. So you can make contributions to that IRA up to that point, but we cannot do it with extension. So if we extend that 1040, which is a really great strategy, we just got to be mindful that we have to take care of that IRA first before that.
Yep.
All right. Then I think we have some. Oh, who's this guy?
Oh, there's Toby Mathis.
He decided to show up today.
Yeah. So, hey, if you haven't yet subscribed to Toby Mathis's YouTube channel, I suggest you subscribe to it. I mean, he's doing really well here. If I look at his channel, he's at 138,000 views in 6 days on how net worth explodes. I don't know what's in that, but
Sounds
hey,
good.
yeah, a lot of people are liking it. So become a part of the 138 viewers, 1,000 viewers. But no, it's a great channel. He provides a lot of important tax information, financial information, and he has that approach that is more common sense when it comes to investing. But if you really want to see a cool channel, hit the button. Oh my gosh, who's this guy, right?
This is what we all look for in every tax
there
Tuesday.
you
I
go.
tell them all
I
the
know.
time.
Yeah, everybody's waiting for that. So I've got my own YouTube channel as well. It's just me. A little bit of stuff going on here about asset protection. Also, I just dropped a video on protecting your house. If you've seen what's been going on with Patrick Mahone and Travis Kelce and a few of the NBA players out there, when they're out of town, people are breaking into their home. Listen, it's a real thing. I had a good friend. She went out of town down to Cancun and started posting selfies of herself in Cancun on Facebook, came back, and her house got emptied out. Somebody looked up her name, found out where she lived. So the idea here is, hey, get your name off of title. Don't let thieves know where you live, because if they find out you're out of town, well, that's just an open invitation, because we know no one's going to be in that house when I hit it. So I'm not going to get shot. So
As a professional athlete, it's pretty easy to know, isn't it?
yeah, it is. Yeah.
Can't hide on Sunday.
No. But yeah, great resources. If you haven't become a subscriber to either of these channels, I definitely recommend it.
All right. And then we have some stuff coming up here, our tax and asset protection workshop. You know a little bit about that, don't
I
you?
do. We're actually down here in Las Vegas today, and this week we're teaching a live 3-day tax and asset protection event. We teach these 4 times a year. I'd love to have you come out there and sit down with us. We go really deep on different strategies. And if you can't make it out to the live one, because our next one's going to be in March of 2025, hey, catch us on a Saturday. You can see the dates here. In December, we're going to be covering a lot of different strategies before the end of the year that get yourself structured and protected so you hit 2025 off with a perfect foundation in place.
Perfect. Back to the questions. I invested in a cryptocurrency a few years ago. I've been staking it directly on the network, and in return, I receive a staking reward. How is the crypto activity taxed? I get a lot of questions about this because crypto still is, relatively speaking, in its infancy. We are learning more and more about how it works and the creative, uses of it behind the scenes on it. But the tax code is trying to catch up. And what they've said so far is we basically have 2 different components here. Here we are staking, and staking is simply that you're operating a business to increase your cryptocurrency. They feed off your blockchain, et cetera, and then they pay you in crypto. When that happens, the first part, the staking event, is usually considered ordinary income. That means it's going to be taxed at ordinary rates and very likely is subject to employment taxes. So there we might want to think about possibly how we're going to work with that situation. But then you do receive the currency itself, the crypto, you get paid in, let's say, Bitcoin. Then later on, you want to sell that Bitcoin. Now, when you receive the Bitcoin, again, it's been taxed at ordinary rates. That becomes your basis, your tax basis at that point. But if you sell it later on for a profit, then that's going to be capital gains. Now, as a short-term or long-term, well, it just depends on when you received it. And then we take that, we start that clock for whether it's over a year or under a year, depending if it's short-term capital gains, which is taxed at ordinary rates, or after a year, long-term capital gains where you get a more favorable lower tax rate.
Yep. I'm not going to touch that one. You answered that one just perfect. But I was looking at one that just got posted up here from Julian. It said, I've been considering opening an offshore trust that owns an offshore LLC that engages in Forex day trading business in the Cayman Islands. To only pay taxes on distributions received from the trust that way, I can grow capital outside the US. Am I on the right path here? And there are other consequences that I should consider. What would you say about offshore?
Well, I kind of try and stay away from them because I'm not too terribly familiar, and often Toby and Clint tell me to stay away from them. So I don't have a lot of experience with offshore. I think often it gets kind of gets a little bit of a feeling of maybe we're trying to hide something from the government. Remember, the U.S. government, you've got to declare all your income, okay, worldwide with the U.S. government. So I would not advise an offshore trust. Do you have any feelings on it?
Well, well, I would advise an offshore trust because our Cayman office sets them up.
Well, there you go.
Okay, there you go. And I would then structure it through our Dubai office where we create Dubai limited liability companies. So Julian, you'd have a Dubai LLC held by a Cayman trust. But that goes to asset protection. It really doesn't address your question on the taxation. So the way the U.S. taxes individuals is that you're taxed not only on when we say worldwide income, it's not the income you earn in your own name, it's also the income that you earn through entities that you hold an interest in. So you cannot set up a Dubai LLC, Forex trade through that, and then you're in a Dubai free trade zone. You think, all right, well, I don't have to pay tax because Dubai's not taxing me on this company income. Therefore, I can grow it much quicker. The reality is you will have to pay tax on it, even if you do not repatriate those proceeds, because it's looked through to you individually. So we typically save those strategies for asset protection. I think that if you're trying to reduce your tax rates and you want to go offshore, maybe you move to Puerto Rico or something like that, Act 20.
Yes.
There's opportunities there. So that might be something you explore instead.
Sounds good.
Okay.
Any more questions we got that we want to, looks like they're handling them. Okay, moving on. I have a real estate professional status, we call it rep status for short. I have invested in both traditional rentals and syndications. Both use cost segregation and bonus depreciation. Can I claim the paper loss from real estate syndications together with our other rental activity after electing to aggregate all real estate activity? Is it allowed to claim all losses, or the ones from syndications disallowed? So we got a lot of terminology here. We want to break it down a little bit, okay, get some definitions out here. First of all, the real estate professional status. We are talking about rental activity, which traditionally is what we call a passive activity. That means if you have overall losses, they can only be taken against other passive income. Passive losses match up with passive income. Now, in the case of the bonus depreciation and cost segregation, those are two terms that often run together, but they are separate identities. Cost segregation simply says, if I have this building right now, we're in what we would call a commercial building. We want to depreciate the cost of the building, not the land. And that's usually done over 39 years, straight line, the same amount, many, many years. Single family home, 27 and a half years, just on what we call the improvement or the building. Cost segregation says, well, now hold on. There's all kinds of pieces to that. We got carpet, we got lights, we got the foundation, and all of those independently have a different depreciation life. Carpet, 5 years. The foundation would still be 27 and a half or 39 years, depending if you're commercial or not. So cost segregation study goes in there, breaks the building apart, puts it into 5, 10, 15, or 27 and a half or 39-year property. And that speeds up your depreciation right there. So instead of deducting your carpet over 27 and a half years, we're now doing over 5. We get more deduction up front. $1 today of deduction is worth a lot more, if we've learned anything from inflation, than $1 of deduction in 10 years from now. So that's why we want to front load these costs if we can. Bonus depreciation then comes along and couples up with our cost segregation. Bonus depreciation says, if you are under 20-year life, the 5, 10, 15-year property, you can go ahead and take a massive amount of depreciation. We were at 100% bonus depreciation, which meant all that 5-year you deduct right away. Now we've slowly moved that down here in 2024. It's 60% bonus depreciation. Next year is going to be 40. We'll have to wait to see what the new tax code, should we ever get to that point, that says. But right now, that's what's going on with our cost segregation and our bonus depreciation. So now we have these massive deductions. We're in real estate professional status. To hit that, you have to work over 750 hours in a real estate trade or business that you materially participate. That could be, I sell houses, real estate agent, things like that. I manage houses, anything like that. And that has to be over 50% of your work week. So it typically is difficult to do if you have a W-2 job. Then we have to materially participate in managing those properties, each individually themselves. And that has its own tests, up to 500 hours per building or something like that for each one of them. That's very cumbersome to do if you have 20 or 30 buildings. So you can do what we call aggregation. It's an election. You may pull them all together, and you just have to make that material participation test once over amongst all of those activities, which would include any real estate activity, such as your real estate syndications. So once you've aggregated, we've pulled it all in together, all right? We got our 750 hours. We're putting more time into that, over 50% of our work week. Now, can we claim those losses? Yes, it automatically pulls in our syndication losses because we aggregated. So we'll be able to, those losses are as good as any other loss as long as we meet all the steps in our aggregation. So it would be allowed.
What do I have to say about that?
Yeah, there you go, a little thorough.
All right. Hey, there was a question that came up here that off the real estate subject matter, people are asking about trading and protecting income they generate from their trading account and also protecting the assets held in their trading account. So you care if I just go a little separate here?
Let's do it.
All right, let's just draw something out here. I'm probably going to break the presentation. Oh, there we go. So if you have a trading account, you're looking to protect the assets held inside of the trading account. You guys seeing that? Is the black screen coming up? So there's two different ways to do this. If all you want is asset protection, you don't right there? There you go. Well, yeah, well, it's black. You're not seeing anything because it's a black screen. Gosh, who am I working with here?
Yeah.
It's crazy.
Amateur.
Okay, that's enough for you guys. So what I would do is you create an LLC for your trading account if all you're doing is looking for asset protection. Now, if you want tax savings and you want to find a way to reduce it, like the question that came up and says, hey, I made $2 million day trading this year, then what you should do instead is create a dual entity structure. So an LLC, that's asset protection for your brokerage account. And of course, you know why we do this stuff. We set it up in Wyoming. So if we get sued and somebody gets a judgment against us, they're not just going to go down to Charles Schwab, garnish the account and close out all of our positions and then take our money. We want to prevent that. That's what the LLC is going to do for you. Now, on the active trading side, your strategy would typically look like this. We're going to create a C corporation for you, and then we're going to set up a limited partnership right here, and you're going to be down here. You're a member or you're a limited partner in this limited partnership, and this is where your brokerage account is going to be placed. Now, with this structure over here, what we're doing then is looking for ways to take income that would normally flow down and be taxed at your individual rate, and we want to upstream income up here to the C corporation to be taxed at a flat 21% on any gains that stay inside of there. But what we're also looking to do is expense things out. That means, hey, if I made $500,000 from my trading activity this year, and I could push $120,000 up to my corporation, I've just expanded the opportunities on what I can do with this money. Number one, I'm not going to be taxed on $500,000 any longer like I was when I traded in my own name. Now I'm an enlightened trader. So instead of being taxed on 500, I'm only taxed on what I actually had remaining. Since I sent 120 up, That only leaves me with 380 that's going to flow down to me. So that 120 that goes into the C Corp, that's when we can start looking at ways to expense it out in a manner that benefits me, but is deductible to that corporation. And if you want to take it a step further, it compounds on what we've already been talking about today. If you wanted to put yourself on salary, then you could set up a solo 401k plan up here, and you could jam 69,000 into that plan, and now you could start trading in this account on a tax-deferred or tax-free basis, depending on where that money sits, whether or not it's in your Roth side of your plan or it's in the traditional side of the plan. So the idea here is that we use combinations of entities to create tax-saving opportunities that did not exist on their own. By putting these entities together, that's where you can start getting some planning working in your favor. Even if you have an existing business, I mean, we run into people that will have maybe an S Corp and it's doing really well. And they're like, well, how do I reduce my taxes? I want to get some tax savings. Maybe we set up a C Corp over here that provides some type of services to the S Corp. So you're moving it off of a flow-through status over into that C Corp that's taxed at a flat 21%. I mean, moving things around like this, we could go on all day. That's why you come to the event, because that's what we cover here.
Exactly.
Yeah.
With the asset protection. And, we just don't want to just blow over the asset protection. I say this all the time to clients, is like the best tax planning in the world doesn't do any good if you run into Elliott suing you and you lose those assets. So you got to asset protection first. We'll work on the tax planning then. And then, of course, you always want to worry about what happens. You want to take care of your trust, your living trust, and things like that.
Well, yeah, it's one of the things that we do when we do a tax strategy session. We go through and we look at your taxes. We'll talk about this a little bit later. But many times by setting up entities, you're creating the opportunities that you currently do not have. It just amazes me how many people continue to do things, in the same way, expecting there to get different results. Yep. What do we call that?
Elliott?
Insanity. Oh, no. Something like that. But great strategies, lots of ways to put things together.
Yes.
All right, I cut in front of you.
No, that was great.
Yep.
All right. So this is a little bit long-winded, but hold with me here.
Oh, no, are we going to go long here?
I own 3 separate holding companies. LLC taxes a partnership for my real estate. We'd always recommend that. And some oil and mineral rights. A second taxes a partnership for active real estate flips. We might have an issue with that. S Corporation for technology consulting. That's good. I saw Anderson videos on holding a passive brokerage account, not active trading, in an LLC for asset protection. Where do you recommend I'd place this? Would it go under one of these other LLCs or some other holding company? I would prefer to avoid an extra annual federal tax filing if possible. Good question.
I'm just drawing.
Yep. So
Yep.
Clint's got his 3 boxes here of these various that we already are existing. Now, with that, if it was going to just be a passive brokerage account, we could put that in another box we call safe assets. It depends if we want to put it there, or we could do the trading structure that Clint just talked about. Just maybe depends on how much you have in there. But you are going to be adding some returns. I don't know, Clint, how you feel, but I probably would not put it in a box to your already existing ones because we have activity in there that may subject to a lawsuit. Do you have any feelings on that?
Yeah, so I would keep it completely separate because you've got this one set up for the oil, this one set up for the real estate, this one here is their active business. Putting your brokerage or savings account into any of those entities just wouldn't make sense to me. I like to compartmentalize things. Yep. So I would create a separate Wyoming LLC right here for my trading account, my savings account. I'd move it from a personal to a protected place by placing it inside of that LLC. And the other benefit that I think people miss many times when we talk about entity structures is that we think of it in terms of today, but I like to look at it in terms of tomorrow as well, that when you create these structures, they play really well into your overall estate planning. Because now when you think about passing on assets to your beneficiaries, we don't have to list out all the real estate and the various oil and gas interests and then worry about how our children are going to gain title to these assets when we're no longer here. Instead, what you're doing is you're giving them a box, and whatever's inside of that box, they get. And so if I have a box that has oil and gas interests, I just have to give them the box, and then now they own those interests. Whereas if I had those in my personal name, we would actually have to go through a process of changing all of that over into our beneficiary's name, which could be time-consuming and expensive. So by structuring your estate today to get the benefits of tax savings and asset protection, you're also creating a better overall estate planning experience for those of you that are going to be left behind when you're called home. And so if that matters to you, then set up structure. If you really don't care because the kids didn't come over and visit you enough, well, heck, make it a mess. Let them deal with it. Right? Yeah, teach them a lesson. Obviously, they didn't learn the lesson early on in life.
No.
You know what that issue is typically caused by? Not enough belt when they were younger, in my opinion.
Right. Yeah. So
I know when you say, you know, when I was a kid, I didn't have to use it. You just do this with the buckle, and man, they would jump right into line. Yeah.
So we got assault and battery too here. Okay.
I'm an attorney. That doesn't want work on me. Okay.
Wonderful.
I'm not bringing back bad memories for you, am I?
Right.
Yeah.
Internal trauma.
You got to go in the corner right now.
I do remember one time that my dad, the only time I ever got spanked.
Here it comes.
Yeah, because I didn't want to go shopping with my mom. You know, you have to go to that mall. Mm-hmm. And oh my gosh, was that terrible. That was the worst experience of ever going shopping.
You got spanked because you wouldn't go to a mall.
Yeah, it was, well, he didn't want to go either. I learned later on because the football game was on and he didn't want us making all the noise. So, yeah.
So he wanted to get rid of you.
Yep.
Yeah. All right.
Anyway, we got here.
We're back to this again.
Yeah, just a reminder. Oh, I think did we hit all the questions here? Oh, wait, do we have any? I think we got some more. Oh, there we go. Yep. Yeah. I have a primary residence that I plan to rent after 1 year of, a primary residence that I plan to rent after 1 year, which would be in December. If I put it into service this year, can I deduct expenses that were needed to make it ready for that rental, such as a cost seg for this year? All right. So it's your primary residency. Anything you're doing right now to try and add, maybe bolster it up, make it look better before you place it into service, that's just going to get added to your basis, which isn't bad. Just means if you ever sold, you would have less taxable gain, but you don't get a deduction right now. Whereas if we've already placed it into services and we start, depending on what we're doing to improve on it, if it is just that, it's an improvement, that's still just going to go to basis and we would depreciate it now that it's a rental once you've placed it into service. But also you probably have some repairs and regular expenses. And yes, then all of a sudden you could deduct those against that rental activity. So it really becomes a question of when you place into service. That's really a foundational question that we have to ask about when we look at real estate. If it's done before it's placed into service, it's still going to be considered your primary residency in this instance. Afterwards, after we place it into service, you got people in there, then we can go ahead and maybe it will still go to basis to be depreciated, or other costs such as repairs, things like that, you would be able to go ahead and deduct right away against operational costs.
Okay, my turn?
Yes.
Okay, so before though I would even consider something like this, taking your personal residence and just put it into service as a rental because you want a cost seg, remember, it's off your basis in the property. Yeah. So if you bought a property for $250,000 14 years ago, and now maybe it's valued at $700,000, you're thinking, oh, look at all these tax deductions I'm going to get, cost seg a $700,000 house. No, it's based upon the basis. Mm-hmm. So you're not going to be able to take advantage of all of that increase in value for purposes of taxes. That's why I like to do this strategy. You take your house, forget about cost seg, right? This is not going to work. You can't do this and cost seg your property. But what you could do, if I bought a house and I owned it for $240,000, and now that property is worth $700K. If I take that property and I put it into service as a rental, my depreciation basis is based on $240,000, right? So just take, well, actually it's less than that because you have to take land value off. Let's say land value is at 40K. So you got 200K divided over 27 and a half years, not a lot, but I'm going to show you how to triple that now. So rather than do it in your own name or throw it into an LLC and treat it as a rental, the savvy investor, we've been doing this. We create an LLC over here, taxed as an S corporation, and we actually sell your house to your own S corp. We'll sell it for $700,000. Now, people always say, I don't have $700,000 to buy my house.
You don't need it.
You don't need it. Yeah, you don't need $700,000. All you have to do is agree to repay yourself. Do you get along with yourself?
Sometimes.
Okay, it's that spanking issue, which goes back to that, going to the mall. If your wife says you got to go to the mall, what do? Jump in the car right away. I know you do. Yeah. So here's what happens. Now you sell it to the corporation. The corporation, you're able to step up the basis to $700,000 because that's what it bought it for. So now your depreciation is off a $700,000 tax basis versus a $200,000. So we just 3x'd the amount of deductions you're going to be bringing in every year. Because if that house was renting for, let's say you're making $30K a year off of it in rental income or 20, it doesn't matter. The point is this, if you divide 200 by 27 and a half versus 700 by 27 and a half, there's a lot more depreciation deductions you're going to pick up over on this side that you can use to offset that income. So the sale to an entity, again, as I told you earlier, entities actually provide opportunities when we set them up. May make a lot more sense in this scenario. So it depends on how long you've held the house is what I'm getting at.
And I think this is by far the most requested video I get asked about, that you have out there is when you sell it to your S corporation. Clint did a video some time ago about that. And we always have clients asking about that. So this is just a perfect layout. You're hearing it from the man himself. And that's a great strategy. You just can't beat that.
Yeah.
Extra depreciation.
But you just can't get the cost seg bonus depreciation off
That's
of
correct.
that. Yeah. Or is it bonus you can't do?
Yeah, we can do the cost seg, we
Cost seg,
can't do
not
the
the
bonus.
bonus,
And the
yeah.
bonus really is the heavier lift on that for the
Yeah.
depreciation. But great strategy. You can't beat that S corporation. If you're wanting to keep it, if you're going to hold on to it, which it sounds like that's what we're doing here. So excellent how that works hand in hand. And it is, again, all about the structuring. We couldn't do this if we didn't have an S corporation to sell it to. So that's why asset and protection goes so well hand in hand with the tax. If you know what you're doing, and that's what we've been doing a long time.
And you know what? I just showed you the benefit of having the step up in basis so you can offset your rental income. One thing I didn't share with you, which is an even greater tax benefit, if you take your personal residence and you turn it into a rental, you start renting it out, and then you decide 3 years down the road, I'm going to sell this property, and you sell it, then what's going to happen is you've now created a rental property here, so it's all going to be taxable to you, all your gain on that property. But when I sell it to my corporation and I increase my basis, I can elect 121 capital gain exclusion. So I've now sold this property, $500,000 of the gain that my corporation's paying me back is completely tax-free. So not only do I get this step up in basis, I also get to pull $500,000 back on that sale completely tax-free. Whereas if I sold my rental here after a couple of years for $700,000, my tax basis is $240. So then my gain on this, which is what, $460, that's all taxable. My gain here when I sell it for $700,000, that $460,000 gain, that's all tax-free to me. So again, when you're thinking through this, there's a lot of iterations that we play into in putting this strategy together for people that makes a lot of sense from a tax standpoint.
And there are little parts on it, such as, if you're doing it on installment, you want to go ahead and elect the gain up front. So there's other things out there that you have to do around it. So I just say that to say that you do want to, join our asset and protection programs, et cetera, or become a platinum member so we can learn a little bit more about your situation and walk you through those extra little steps that you want to take. Make sure it gets done right.
All right.
Perfect.
We're moving on.
Yep. There we go. Oh, this guy recommends using
Who is that guy? Is that guy here today?
Right? I had to pick it.
Right on.
I had
Let's
to pick the
go.
question.
All right.
Okay. Clint recommends using a
Oh, I
partnership.
like that.
Recommends using a partnership holding company for residential real estate investment. Do I need to start a new IRS filing submission with the partnership holding company or keep it on my existing Schedule E personal IRS filing? I have 25 investment homes, so I'd like to minimize the amount of work for this change. I'm not sure how to do this accounting change. That's the beauty of this structure. Okay, Clint will show you, if he wants to, he can write out 25 little boxes down here that all lead up to just one entity, Wyoming Holding. Well, we'll make them do all 25.
I'm just going to put that
there you
times
go.
25 all rolling down into one Wyoming LLC right here.
Exactly. And the partnership part, one reason we like to do that is it looks better for lenders. And maybe Clint will go into that a little bit here, but it's just one return. It is just going to be one tax return for 26 boxes that he just put up here. That's it. That's all we've had to gain is that one partnership return. And with all the benefits you're going to get from it, it's worth it more than likely. Set up a management corporation, but that's something else. But that's really, now as far as your Schedule E, it's still going to, what's going to happen is your 1065, the partnership will file a return, 1065 return, which will give you a K1. That still comes to your 1040 on what we call Schedule E. It's just on Schedule E page 2 or part 2, as opposed to page 1 like it has been before. But maybe you can go into about that partnership.
Okay, so where did this come about? About, I don't know, 18 years ago, when I was just practicing, I was young, I met this guy in California, a real estate investor, and he had a lot of properties, he had a lot of entities set up, he's working with a CPA, and he came to the event, and I structured him with a holding company, because that's all he needed. And I said, well, put this LLC holding company in place, and we'll have it hold, actually, excuse me, that's not what happened with that one. This one, he already had the holding company treated as a partnership. And so when I sat down with him, I was trying to add value to the relationship. I said, listen, if we take your LLC that's a partnership and we turn it into a disregarded entity, you can have all these LLCs and you don't have to file any tax returns. So you save on that CPA filing. And he said, oh, I don't have to pay my CPA to do a return. I said, nope, it's going to be disregarded. So essentially what this person is who sent this question is, that's where they're at right now. They have everything flowing down to their Schedule E page 1, and that's what I was recommending to him. Now CPA said, don't do it. But the guy liked me, and he said, yeah, I want to follow Clint's advice. Let's turn my holding company into a disregarded entity so I don't have to file a partnership return. So we did that. A few years later, he was audited. And he made it through the audit just fine, but he had to go through it. No one likes to go through an audit. And I got on the phone with him and his CPA, and the CPA brought up the fact that what triggered the audit was the fact that all these properties are on his Schedule E page 1. Because when you have a lot of real estate and you don't have a partnership there as a blocker entity, as I refer to it, all those properties show up on Schedule E page 1. And you keep having to add different Schedule E's and different schedules there, and so it blows up your tax return. And the problem with that is that when you send in a 1040 with a lot of different schedules attached to it, there's a lot of IRS agents who can only audit 1040s, and they see something they're uncomfortable with. Well, what are they going to do? Let's put it over here and we'll take a look at it and audit that return. Whereas when you take those same properties and you run through a partnership, through a 1065, you have a very small pool of IRS agents that are qualified to audit 1065s or business returns. And so the likelihood of being audited is much higher when you run everything on your 1040 Schedule E page 1, all your real estate, versus protecting it with a 1065 partnership return. So the reason why we started recommending this was out of that experience that my client had. And I told him, I said, I'm sorry, I didn't realize this was going to happen. And he was fine with it. He said, hey, it was a learning experience, and he didn't hold it against me. Thankfully, he's still a client. But it did teach me a lot of things. And that CPA that I spoke to, he'd been doing taxes for 20 some years. And he said that was his experience. He used to work at the IRS. And he said, hey, at the IRS, I knew exactly how this played out. That's why he had recommended it to this joint client. And so we like to do it from that standpoint, reducing your risk of audit. But more importantly, you hit on this. It makes you look better to lenders. If you deal with conventional loans, Freddie Fannie stuff, and you've held real estate for less than a year and a half, and you want to use it for qualifying for that next property purchase, what can happen is if when it shows up in your 1040 Schedule E page 1, they have to hold back 25% of your rental income for vacancies because you don't have enough rental history there. So where that can be a problem for us, and I've run into the same problem earlier on in my investing career, is that you think you're going into this loan, you have plenty of coverage on the income to service the debt, and all of a sudden they start taking the income away and that margin gets compressed down. And like, no, you can't, you don't qualify any longer. It's like, what are you talking about? I got the income. Yeah, but we can't count all that income because the underwriting guidelines prohibit us from doing that. So the way you trump that is you run it all through a partnership and they're allowed to count 100% of it. You can own a property for 3 months and you can count all of your income if it's through a partnership. But if you didn't have the partnership, you couldn't do it. So there's tactical reasons to making yourself look better to lenders, reduce your risk of audit, of using a holding company in Wyoming like I just drawn out here, and treat it as a partnership for tax purposes.
There it is. Yeah.
That's it.
Great strategy. And again, just one return is all we're adding to your bucket here, the partnership. But with all that, I can think you see the value behind it. And I think that's just a far superior structure for you. And you got that Wyoming LLC charging order protection. Good stuff.
Yeah.
All right. And I think this is our last question.
Now, I'm just going to do a follow-up on that
Yeah.
strategy. I talked about selling your personal residence. Drawn as, how about selling it to a C Corp for a tax benefit? There is not a tax benefit in using a C corporation for that strategy, okay? It's the S corporation that provides a tax benefit because of the flow-through nature. You never want to trap real estate inside of a C corporation unless you're flipping. Flipping out of a C corp makes a lot of sense, but holding rental property in the C corporation never pencils.
That's right.
Yeah.
All right. I have a relatively new corporation whose expenses exceed income. So we got losses. Can these expenses be used to offset income in 2025? If so, how would I indicate this on this year's tax return? When we have a net operating loss, this is what's going on. We have more expenses than income. It's a loss. It can carry forward into the next year. There are some limitations due to our Tax Cut and Jobs Act that we got signed in 2017. And what it says is that, let's say we have a $100,000 loss in 2024. We go forward to 2025. We have to see what the taxable income is on that C corporation in 2025. Let's say again, we have now we have $100,000 of net income in 2025. We can only wipe away 80%. Okay, we're limited. 80% of that net gain is the most we can take. So we'd have the carryover, the 100,000, wiping away 80,000 or 80%, and then that other 20 will just carry on to be used in 2026 per the same rules.
Yeah, and if you don't make money in the C corporation, we set it up for you, and it's traditional Inc., by the way. So the strategy we're going to share here is not using an LLC to be taxed as a C corp, but setting up a traditional Inc. And this is one of the main reasons why we like to do this for our clients who desire C corporation tax treatment, is because if you choose to shut that business down, you're eligible then for the way in which we set up our corporations for 1244 stock loss treatment. And essentially what that means is that any losses that have not been utilized inside of that corporation, like Elliot said, let's say that you carry that over, you only make $10,000 and now you're sitting on $90,000 losses and you think, oh, I'm going to try this for one more year, and you make another $10,000 in income and now you got 80K in losses, and you're sitting, all right, just skip it, right? It's not working out, you want to shut it down. Well, you shut that down. If it's set up as a traditional Inc. and we have 1244 stock loss treatment, as we do, we built into it, you can take that 80K, you and your spouse, and you can then apply it to your W-2 income that year in which you close your business down. That's one of our core strategies for a lot of people that start up businesses, and then they find, hey, I want to go a different direction.
Exactly right. And the government put that in for a specific reason, to encourage people to put into new companies. So there's a lot of purpose behind what's in the tax code, but it was designed to encourage investment in new businesses so that people could get that ordinary loss, as long as they follow all the rules and the guidelines. Again, yes, it's a great strategy, and we can take that 100,000, but you're going to want to make sure you check all the boxes. I recommend, again, talking to somebody for some tax planning, make sure we know what we're doing on that.
Yeah, because I mean, you go out there's so many CPAs, attorneys, they just pump LLCs all day long because they're not thinking about the future, about what could possibly happen, and creating exit strategies for individuals that they're working with. And so that's why we're really careful when we make a strategy recommendation, whether or not it's an Inc. versus an LLC, because we're thinking down the road, hey, we ask you questions. How much are you going to invest in this business? What are those ongoing expenses going to be? What are your expected income looking like? And then once we've got that number figured out, then we'll make a determination as which business structure is probably better for you from a future financial standpoint.
Exactly right.
Yeah.
And I think that gets us
Well, it brings us up to what I want to talk about here is our Tax Saver Pro package. So if you're not familiar with it, what we do here at Anderson, we have this great package. It's called Tax Saver Pro. It's run by Elliot. And so if you're one of those that's been sitting around wondering, hey, where are these tax deductions coming from? What applies to me? What we've developed is a system where you'll be working with us, and what we'll do is we'll analyze your situation, and we'll go through it, and we have over 1,500 different tax strategies that we stress test against you to find opportunities to put money back into your pocket. We've saved some clients over $120,000 in taxes by running and working with them through this system to look for those opportunities. And then we push it forward. We also look at it for this year, and we analyze it for future years as well. So then you know going forwards, hey, if you just do these three simple things right here, you're gonna receive this type of savings by putting this in place. And so if this is something that's of interest to you, you've been sitting around going, you know what, my tax guy's just not helping me out here, and you want to find out more about what's available in the tax code that can benefit you. So if you've been hearing tidbits of information you've never heard of before, like the strategies we've been sharing with you, then you definitely want to look at our Tax Saver Pro package. I believe right now we've got a special, it's $19.95 or $97 to join this. Guess what? If we can't save you 2 times the investment, we'll give you all your money back. So you've got no risk in going forwards. If we can't find you the savings, we'll give you a complete refund on the investment. But going forward into 2025, there's a lot of opportunities out there, and working on this Tax Saver Pro, we'll create a full tax plan for you. So if you're not using us on the tax side, take it to your tax professional and say, hey, these are the 6 things that I want to implement now to put money back in my pocket. And if you decide you want to work with us, well, then we'll give you a $500 credit again towards working with us on the tax side. So it's a great package. I mean, what do you think? What's the average person? What do they save?
I think we were seeing on average it was about 30,000, I believe.
30,000. Yeah, that's a lot of money to be saving. That's just 1 year. And again, think about that going forwards.
Keeps multiplying. And certainly some of the strategies, once they start to see it, you'll start to see clients kind of open up, okay, now I'm not as scared of these strategies. So actually, we probably could up that 30,000 number a little bit.
And find more opportunities there. Yeah. It's a great program. I'd love to make you part of it. And your opportunities, all you have to do is go to this link right here, aba.link/TT Saver. If you click on that link, and then you can see everything that's included in the package. Again, there's no risk for you to sign up. You'll be talking to Elliot or someone on his team, and they'll be gathering information from you, and then they're going to run some full-blown plans to show you where we can put money back in your pocket.
Absolutely. And just one more reminder, we do have our nonprofit workshop coming up December 12th with Kareem and his staff. So if you have any questions about that, do we have a link for that, Patty? Maybe we can put out there?
Yes.
Just going to put that in the chat. So we got, again, that's our nonprofit tax workshop. Year-end, it's one of our big strategies. If you want to put into a nonprofit, maybe we can't get the nonprofit set up between now and December 31st, but we have a way to work with that. Kareem, always a genius, always looking at things. We can work with a donor advised fund, put money in there, and get your deduction here in 24 before the closeout.
Yeah. So again, it's just finding the opportunities, and that's what we do here at Anderson. So if you're not yet working with us, here's a great opportunity to get involved. And so with that, we need to see a little more Toby. So here's a little more Toby that we have for you. If you're not yet a subscriber to his channel, he likes me to put this up twice, 3 times, potentially was in here originally. But no, again, it's a great channel, lots of strategies, videos he drops all the time. Why are you laughing? Because there's some truth in that, huh? Even Patty's back there cracking up. Oh yeah, look at those emojis that are coming up. Yeah, we know, Toby. Hey, let's talk about tech. Oh, here's my channel. Let's talk about tech. Here's my channel. And again, there's mine as well. Is that the last slide? No, the last slide is this, the events. Guys, you want to take it all and show you how to put it together? Come to one of the events, check them out. If it's not one of the in-person live events like we're doing here in Vegas, they're free workshops on Saturday. If you know someone who can benefit from this type of information, send them the link to our website to go there and register for it. And we'll show you some strategies, how to make yourself anonymous, how to protect your assets, and also to take what Elliot has been touching on in these questions here, how to take real estate and make it your friend and really help you reduce your taxes and plan for your estate. There's a lot built into that 8 hours of information, plus you got the Q&A that comes from working with our attorneys and our tax professionals that are there answering questions like we have on this event.
Absolutely.
All right.
Well, thank you all.
What do we do now?
I think we hit the happy.
Oh, there you go.
Yeah, I think that's and just a reminder, if you got questions, submit them to taxtutor@andersonadvisors.com. That's where we pick from the pool of them, and visit us at andersonadvisors.com.
All right.
Thank
That's a
you, and
big
see you in
sign-up.
2 weeks.
Thanks, guys.